Hello.
Good morning, good afternoon, good evening. Thanks everyone for joining our latest call on President Trump's policies, how they're impacting the industrialized world and our clients who focus on the industrial sector. There's a lot going on. I'll start off by saying happy Tariff Day to everyone. We've been talking about this for quite some time, and we've just had tariffs implemented on Mexico, Canada, and increased on China. There's a lot going on right now. There's a lot to talk about today. We're grateful that everyone's joined us. I'm Ambrose Conroy with Seraph. Please feel free, if you like what we're saying, follow me on LinkedIn, follow Seraph LinkedIn, and subscribe to our Transforming Industry newsletter there. Justin Fortier is joining me today.
Hello, everyone. Thanks for your continued support, whether it's downloading our presentations on our Seraph Tariff Tracker page. We've got that set up, and we're trying to keep it updated as soon as new announcements come out. So you can find that at seraph.com/tariff tracker. And that's where you'll be able to download the presentation that we're sharing with you today. And we can use that to invite you to future webinars that we'll do over the next month, because there is a lot on the way.
So why don't we jump right into things? So Trump has been very clear all along. He has a strategy, and it's a strategy that the U.S. has lacked for the last several decades. We are reindustrializing the United States, and it is very clear that he has a message, and his message to manufacturers is make it in America. Put your supply chain here, put your manufacturing here. And he has laid out a plan to incentivize people to do that. Phase one is tariffs. Phase two is tax breaks for companies that do manufacture in America. So right now we've got a few tariffs that are in place that came in today at 12:01 a.m. or are planned to come in. Let's take a look at what came in today. So we have the tariff on Canada, and that was Executive Order 14193. What that does is that puts a 25% tariff on goods coming in from Canada, and it carves out energy. And we don't know if that includes electricity, but it carves out energy, and that's a 10% tariff rate. Mexico was hit hard. Mexico has a 25% tariff rate across the board. Normally with these things, when they come out, you get things like food, medical devices, pharmaceuticals that are essential, that are excluded. They are not in this time. They are very much within the focus, and they're part of it. The executive order for Mexico was 14194. So we've got those in place. For China, Trump is very slowly, very deliberately ratcheting up pressure on China. There's now a 20% additional tariff rate since he took office. That's building on top of previous tariff rates that were in place. He had put rates in his last administration. The Biden administration further increased those rates, and now he's building on top of those, trying to achieve an objective here, which is to drive companies to start to move their supply chains back to the United States. Now, one of the questions that I'm constantly getting asked is, why is he creating this arbitrage opportunity where Mexico is no longer a good place to be, Canada is not a good place to be? I think what he's doing right now, and if you read his book, The Art of the Deal, is he's thinking big, and he's being very loud with what he's saying. This is how we treat our friends. And if this is how we treat our friends, you sure want to be one of our friends. You don't want to be one of our enemies. There are a lot of countries, there are a lot of blocks around the world that have higher trade deficits. And we want to understand he's tackling the top three right now, but he's not going to let other countries take advantage of free trade and penalize those that are our largest trading partners. He's going to make it hard. And when we see April 1st's findings come out with reciprocal tariffs that we'll talk about in a little bit, we'll see new tariffs, and that should equalize things globally. So we'll have tariffs from every country around the world, which will be a very different United States worldview. My view, and people take issue with this, is that globalization is dead. Other people will say globalization is under attack. But regardless, the way we've done business in the past, having very complex cross-border supply chains, is no longer effective with this U.S. policy. So we called these tariffs correctly. We've been talking about this for quite some time. We've been very clear that these tariffs were coming. And by saying they're coming and you need to prepare, we've had a lot of clients who have stepped up. We've helped a lot of clients doing the analysis and then moving from just having the data model to actually implementing things so that you can start to dual source, so that you can start to move those products, which can be moved quickly and easily. Those that haven't adjusted, those that haven't raised prices, those that haven't moved the supply chain, those that haven't taken efforts to bring product back to the United States for the US market are feeling a lot of pain right now. And that 25% tariff on Canada and Mexico for things that cross the border multiple times will be very impactful because there is no duty drawback allowed in these tariffs. So that means that if you cross multiple times, you're going to end up paying more each step. So Trump has been consistent with what he's been talking about. He's been talking about trade deficits for decades. He doesn't like it. He thinks we're getting a bad deal and he wants to make things different. Border was his first point in his 20-point plan. So his platform has really been, how do we reindustrialize the United States? How do we stop other countries from taking advantage of us? And then how do we make America great again? There's a lot of political pain around Make America Great Again. But one of the things that I think about really is being upset with politicians doesn't help. Trump won, and he won with a significant, uh, significant push, significant drive that has allowed him to move things forward. He has the ability to push Congress. He has the ability to push the Senate. He has the ability to drive things in a different way than any president has in quite a while, and he's doing that. He is now looking at his platform. There are a few things here. Number 5, he wanted to stop outsourcing. He wanted to bring manufacturing back into the United States. We created a tremendous manufacturing engine in China, but he thinks it's a bad deal, and he's acting on that. And he's acting on it in a way that's upsetting people all over. Being upset with Trump is fine, but we have to acknowledge that he has a manufacturing and an industrial strategy, and he's executing it. He has been clear, and everyone loves to say he's not clear on what it is. It's very simple. The quote on the bottom, I think, says it all. My message to every business in the world is very simple. Come make your product in America. He's lowering tax rates on manufacturing to 15%, or that's what he's working on, and he's putting tariffs in place. So there are also a lot of structural differences we're seeing in this Trump administration versus the last. In the last, he was trying to figure out how to be a politician, how to get his cabinet put together, how to get his infrastructure put together, how to get his team all put together. So that's really, really key. Trump's platform is now the Republican Party platform. As he's moving quickly, as he's getting his structure in place, he's driving forward. He has a Republican House and a Republican Senate, and he's got a favorable Supreme Court. So there are all these fights over the things that he's doing, but he's moving at a lightning speed, and his lightning attack on the government to lean it out, to change things, is moving so fast that it's hard for people to fight it. By the time they get a court order saying do something, he's already stopped it, and it's very hard to turn it around. The bureaucracy is working against him, but it's also working for him at this particular time. The other thing that I want to point out here is that we believe very clearly that change is going to be constant here. It's not just what we're seeing right now. We're going to see ongoing turbulence. So we've seen the first wave of tariffs hit. We're seeing the second wave being planned for, and then we're going to see other things change. We're encouraging everyone, have data and models, but don't stop there. Understand that there is a reindustrialization strategy in the United States, and you have to make products in the United States to competitively sell in the US market. That's very different than what we've grown up with. I grew up, and my whole working life was in either NAFTA, USMCA, where we really focused on doing things cross-border. I saw a lot move to China. I saw things move all over the world. We're now at a point where we're not only looking at regionalization, which was what we talked about coming out of COVID, we're looking at nationalization, bring it back within the borders. I think the European Union will follow along with this. I think as Trump's tariffs continue to squeeze China, their excess manufacturing capacity and their need to export will start pushing even more cheap products into Europe. And my gut tells me that Europe will be 12 months behind the United States in putting in tariffs on goods flooding into the European Union.
There's one thing I wanted to call out on this slide as well. So under his reindustrialization plan, I think he's looking to counterposition a bit to what both the Biden administration was talking about with EV mandates and the alternative energy. He's been pretty clear that he's not against developing other forms of energy like solar, but he is very interested in finding ways to lower the cost of energy because he knows that's a key input, uh, not just for the whole economy, but also for manufacturing. So, where we've seen energy prices be quite high in a country like Germany, he's basically trying to lay out an opposite case for manufacturers where they could have low energy prices and uh, low taxes as well, as Ambrose has already mentioned. And at the bottom point on the left hand side under his philosophy, he is he's been very eager to co-sign some of these large deals. Now the way some of them are written looks like they are appealing to him to get them to share, but we've got several examples. We've already talked about Stargate, which is a large investment, $500 billion investment project over many years that was announced by Oracle and SoftBank and OpenAI and other investors. Then Apple recently packaged their investments. They got a big $500 billion headline as well, although that's more than just manufacturing. And we saw Clarios announce a big investment as well. And Trump has been eager to share all these examples and use his platform. If companies are making big investments, he likes for them to come to the White House. He gets to say something, they get to say something. So he's trying to hold up those companies as examples. And when we're following kind of all the announcements coming out from the White House, that's the model that's aligned with pretty much everything he's saying. And the other key message on this slide is that there is some unification that he now has, where he has more power and momentum, that he intends on actually deploying these ideas. He's been thinking about them for a while. There's a great Letterman interview from the 80s where he was talking about Japan, and now he finally gets to test those theories out. Theories he didn't really get to test in earnest until halfway through his last presidency and in a much reduced fashion. But he's clearly setting the pace for his cabinet this time, and they've been quickly supporting him on that, which is a big difference from just a few years ago.
And Justin, I was trying to avoid using the word mandate, but Trump does have a mandate. The voters gave him a mandate, and they're pushing him. And we may see companies out of Korea, Japan, and other places having a short-term advantage as things are uneven, but that will not last long. There's a very short arbitrage opportunity. And I think you pulled this quote, and I think this is a really good one. So Ryan Peterson from Flexport, he agrees with us, and he's seeing the same kind of things. And Flexport's a large logistics company. Mexico and Canada on the table. A key thing is I don't think there's any country that can be a safe haven to avoid tariffs. I would expect the new duties to be imposed on Vietnam, India, and every other up-and-coming manufacturing center. Trump is not sympathetic to arguments that we need low-cost labor. He wants things in the U.S. He has the support of union workers. He has the support of the blue-collar workers, and he's doing a lot to try to help them and bridge the gap and bring these jobs back into the United States. And there will be some short-term pain. We will see some inflation. It shouldn't be massive, but we'll see some inflation driven by this. We're going to see possibly interest rates, depending on the inflation, depending on what happens, move. We're seeing unemployment increase right now as federal workers are cut, but he's trying to create more manufacturing jobs for those workers to move into. So a lot's going to change. People are going to be moving. We're going to see shifts in America. But if we look back, for me, it's really taking a look at where we were in the United States, and if you want to move ahead, Justin, from 1937 to 1945. The United States really had this great period of time. We had deindustrialized coming out of World War I. No one wanted us to have that industry. People were terrified of going back into war again. But in 1937, the United States made a decision, and FDR and Henry Ford came together and they started to look at how could they reindustrialize the United States of America. And over that period of time, from 37 to 45, we doubled industrial output. Now there was somewhere to send it. There was unlimited demand, so we were able to grow as fast as we could. I think we're at a point now where we're trying to capture some of that demand again, and we're trying to reindustrialize. We're focused on reindustrializing the United States, and Trump's mandate carries forward here. So we're 1 month away from these global reciprocal tariffs that Trump has talked about. And he said that he doesn't want to do it on April 1st because he doesn't want people to see this as an April Fool's Day joke. He's very serious about this. So we've got these executive orders that we've talked about already with Mexico, Canada, and new on China. He's got a 25% additional tariff on aluminum and steel coming into the United States. And then he's looking at how does he layer in higher tariffs on Chinese goods? How does he look at things like autos, semiconductors, pharmaceuticals? One of his big things that I heard talked about when I was in DC a week and a half ago was specifically from the pharmaceutical and medical device industry. Why should America pay for the development of these products for the whole world? Why do we have the highest prices? Why do some drugs cost 10 times in the United States what they cost in China? And very much focused on that. So I think that industry is going to see quite a bit of upheaval, and they may also be blindsided by the changes and the tariffs that are coming. His message is very clear: make it in the USA. So the reciprocal tariff plan, I think, Justin, you may want to talk a little bit more about the reciprocal tariff plan and what we know there.
Yeah. So one of the clear takeaways that I think anybody looking at the tariffs on Mexico and Canada would appreciate is that that is going to incentivize people to move to other countries like Vietnam, et cetera. And that would be the first thought for most purchasing and sourcing groups at companies. But that's why Trump has announced reciprocal tariffs. And this, he's given himself a broad definition of what he expects the Secretary of Commerce and Treasury and the trade representative to come back to him with. And we've discussed this a bit before, and this is now April 1st is when the report is, and they said they're going to start rolling out bits of that recommendation as soon as April 2nd, but it's not just tariffs on one for one. He's also looking at other elements like non-monetary trade barriers, certain subsidies of certain industries. His goal with this that he's talked about, that his representatives have been talked about, is to give what they call the U.S. businesses or businesses manufacturing in the U.S. equal footing to compete. So we're expecting pretty high, more than just one-to-one. So you're not just looking at is there a 5% tariff, but does this country subsidize? Do they have certain protections against foreign imports that are beyond that title? And if we look to the countries that actually have large surpluses, trade surpluses with the U.S., or where we're running a trade deficit with them, and from the U.S. perspective, the big countries are China, Mexico, Vietnam, Ireland, and Germany. So we would expect that he's probably challenged his team under that reciprocal tariff guidance to figure out how he could get that to a more even level.
And Justin, I want to single out Ireland for a minute. So we've got an office in Ireland. We're pretty connected. I read a lot of the news there, and there's a lot of negativity about Trump and what we're doing, what the Americans are doing in different places. And I'm not going to devolve into politics, but there's even a threat that they're not going to send the Taoiseach over to the White House for St. Patrick's Day, and that I think would be very, very short-sighted. Ireland is in a great position right now. There's a very friendly relationship with the United States. President Trump likes Ireland. He's got a fondness for it, much like many past U.S. presidents have. But there's a very large trade deficit number. and that is where taxes are captured for U.S. services and software companies. So we've got a lot of companies that decamped to there to change their domicile or have IP there. It's where Apple and Microsoft have paid, and Google have paid large amounts of taxes. And the Irish economy is very dependent on those. And those countries that are incredibly critical of the United States yet are almost entirely dependent on the revenue that they collect from U.S. taxes or taxes on U.S. companies. You need to be very careful because Trump sees those as U.S. taxes, and he believes those should actually be paid to the United States, and may take some moves to make it very, very difficult for things to continue as they are. That would decimate the economy in Ireland and have very serious knock-on impacts across the EU. So we want countries to really look at this, and we want companies to be very careful with what they say and any political positions that they take. We try not to take political positions, and we encourage our clients not to as well.
I've got one point I want to make as well on this overall map that we showed earlier, because I saw a question come in on the chat about when the steel and aluminum tariffs will come in, and those are coming in on March 12th. We haven't seen anything to change that, so we expect those to come into place. And one of the key words that is on this slide and has been in the messaging for the Canada, Mexico, and China tariffs is that they are additional. And that means that that's on top of sector specific tariffs. So if there are certain tariff codes that are already in place in China, for instance, like the EV Chinese tariff code that was in place under the Biden administration, this would be an additional 20% on top of that 100% tariff. So as you're evaluating that, make sure that this 25% is not replacing other existing tariffs, because that could lead you to calculate the impact incorrectly.
And we're assuming all of our clients and everyone we're talking to here has already done their homework. You've got a model developed. You've assigned the uniform tariff codes for each of the products that you support across import from your supply chain. You understand where things are coming from. You understand at a tier 2, tier 3, tier 4 level. And by having that in place, you've already done the no regrets things, and you started to move things as you can into the United States to avoid that tariff. If you haven't done that, you're massively behind. And now, as you start to need to implement, very few companies have tariff response teams developed and in place that can help do rapid relocations, that can help do dual sourcing. They don't have the skilled and capable people around. We have a couple of tariff teams ready to deploy to new clients to help support that. You need to really look at what the cost is of these 25% tariffs on Canada and Mexico, and what the cost will be of these global reciprocal tariffs. A lot of companies have, to this point in time, really treated this as theoretical. It's no longer theoretical. We now know that it's coming into play, and there's a lot of pain associated with this. So if you haven't taken the initial actions, if you're behind, please reach out. Happy to have a conversation, whether you engage us or not. But the goal is to get companies to really understand what their pain is going to be and how they can move very, very quickly to minimize that pain, protect profits, and move to capitalize on the Make It in America focus and the U.S. industrial strategy that has been put forward.
Yeah, and before we take questions, if there are a few more, if anybody wants to put them in here, and we're happy to also take questions. We're going to continue doing these webinars. So if you post one and we can't get to it today, we'll definitely include it in our next report. But just looking,
feel free to reach out to me directly, or reach out to Justin. We're happy to come back with some answers to you.
Yeah, exactly. And one piece, hopefully I think it's loading, but Ambrose, is it showing
slides up? Yep, the slides up,
okay,
the
great.
services slide.
Awesome. So one of the big headline numbers that he's looking at, or he's referenced in multiple talks, has been the global trade deficit. And as you can see, it's as trade has continued to grow, that absolute dollar value of the goods deficit has also grown. Services is actually an area due to software companies and some other things that the U.S. has a small trade surplus with the globe overall, but the goods deficit is what he's really focused on, and that's more than 4 times larger than uh, the services surplus.
I think if we're honest, Justin, Trump's not going to focus on the services surplus at all. He wants to build as many surpluses as he can.
Yeah.
And he wants to really make sure that any deficits are addressed. He wants a good deal for the United States. He no longer wants, in his mind, bad deals. So that's where his focus is. Do we have more questions at this point in time? I know this is a lot that we've thrown out at everyone, and we're planning on doing another webinar coming up. I'm going to be in Europe next week and the following week, talking to a number of clients about U.S. industrial strategy and what it means. I think the U.S. industrial strategy goes far beyond tariffs, and we want to help people understand what that means and how you can really prepare and leverage what is a clear U.S. industrial strategy to do well in the United States. So we'll be doing something on that coming up. But are
Yeah,
there
there's
some more questions?
one question right now, which is from Shogi. Uh, with the potential for higher tariffs on aluminum and other key materials, how do you anticipate North American OEMs adjusting their supply chain strategies? What material shifts, such as aluminum to steel? Okay, so he's actually talking about switching an underlying commodity. Uh,
So
will you see?
yeah, I think we're going to see quite a bit moving forward. I think we're going to see fewer new model launches. I think we're going to be reworking models that we have. I think we're going to be looking at how can we bring our supply chains back into the United States, what suppliers and materials are available. And we're no longer going to be looking cross-border for that. We're going to be looking very clearly within the United States. There was a theory that I heard pushed out that OEMs thought that they would be able to take a small part of this tariff increase, have the supplier and have the customer take small parts of that. Our view is that customers are paying as much as they're going to pay when we do our automotive report. For automotive in particular, end customers really don't have the bandwidth with interest rates where they are to pay more for cars. Suppliers don't have the margin to take on this tariff. So the tariff increase in almost every case will get pushed to the OEM, and I think we're going to see more and more pushback from suppliers to the OEMs saying, "Hey, it's yours. We can't do this. We're stopping shipment at this point." Luckily, or unfortunately, or fortunately, there remains a large inventory of vehicles within the United States. So there's a little bit of time for these issues to start to work out, but we'll see an economic impact almost immediately. And I think that's a lot of the short-term pain that's coming.
Yeah,
Lots of potential for disruption here. And we're also watching the border right now. We're not seeing massive challenges yet today, but I think those are going to build as we test this mechanism. So we're encouraging those clients we're working with right now, and this is outside of that question, to really look at what material you have and make sure that you have backup plans and plans for things to take an extra week or more to cross the borders. This is not necessarily going to be a smooth implementation. The government took some extra time so the bureaucracy could adjust, but customs and border protection doesn't necessarily drive confidence when they're putting in changes. So I think this could be a bumpy ride for all of us. We'll just have to hang on and wait.
yeah, and there was an admission that came out over this weekend related to mostly e-commerce and smaller merchants that use the de minimis exemption for when you're importing if the value is less than $800 in the shipment size that you have. Um, that has been an a exception. Some people would call it a loophole, but it was the standing rule that Trump looked to unwind when he announced the Mexico and China and Canada tariffs. But the White House did have an admission over the last week due to the challenges of rolling out that collection process that those will only go live when the Secretary of Commerce says they have the capability to collect them. So that's one reason why the reciprocal tariff delay is also happening, because if you've they knew that administratively it'd be far too difficult to roll these out all at once. So that's why there's been somewhat of a staggered approach.
And I just pulled up the border crossing times because I was always curious. I pulled up El Paso and Juarez because that's always an interesting one. It's very interesting that the Bridge of Americas, they're saying for commercial traffic, there's just a 20-minute delay, but they're looking at others and the Bogota cargo facility right now, they've stopped reporting on that. So for me, that's a very interesting thing, and I'm going to try to figure out what's going on, and we'll post an update here on that. Appreciate everyone joining us for this call. We'd welcome a chance to talk more about this. We'll be running another webinar on the industrial strategy of the United States. I think that will be helpful for a lot of companies here that work cross-border. And welcome your questions. Again, please follow me on LinkedIn. Please follow Seraph. Subscribe to our Transforming Industry newsletter, and we'd love to chat more. So if you have questions, reach out. We're happy to chat. Thanks very much.
And one final point I'll leave everybody with is, as you're thinking about your competitive landscape and how tariffs will impact, we've mentioned that there probably will be price increases in many input costs related to the tariffs, but it's important to not just think about how tariffs will impact you, but also how they'll impact your competitors and your suppliers. So if you have a product that has, really low substitution, like there are a few alternatives, and it's required, and there's going to strong economics, or economists would call it inelastic demand, like it's not super sensitive to price, that's going to be a very different situation than if you have domestic competitors that already have significant manufacturing and sourcing inside of the US. And let's say you import from China or Mexico or something like that. So consider that as you're thinking about what your capacity to raise prices are, and how these tariffs will actually flow through to your bottom line. So thank you everybody for joining today, and all our emails are there. If you need to reach me, you can email research@seraph.com, and we'll get back to you.